As a trader, you are probably familiar with the several theories, conception, market structures, and cycles. Some of these are popular ones, including the Elliott wave principles and down theory. In today's video, I'm planning to add the more important type of the market analysis to your trading arsenals, namely a price actions based on the approval known as the WYCKOFF trading method. The WYCKOFF method consists of the series of principles and strategies which can be applied to all sorts of the financial markets. I will break WYCKOFF methods into the four parts. There are three laws of WYCKOFF: the composites WYCKOFF price cycles, WYCKOFF volume spread analysis, the three laws of WYCKOFF. WYCKOFF method rests on the fundamental laws. First, the law of supply and demand: when demand is greater than supply, price rises, and when supply is greater than demand, price falls. The trader can study the balance between supply and demand by comparing price and the volume bars over time. As a way to better visualize the relations between supply and demand, this often provides insight into the next market movements. Second, the law of cause and effect. The second law: strategies that are different between supply and demand are not random. Instead, they came after periods of repairing as a result of the specific events. In WYCKOFF terms, a period of accumulations cause eventually lead to on-trend effects. In contrast, a period of distribution causes eventual results in the downtrend. Third, the law of effort as a result. The third WYCKOFF law: strategies that the change in essence price are the result of the effort, which is represented by the trading volume. If the price actions is harmful with the volume, there is a good chance the trend will continue. But if the volume and the price divides the market, the trend is likely to stop or change directions. For instance, imagine that the market starts consolidate with a very high volume effect. One computer trend. The high volume indicates a big effort, but the sideways movements suggest a small result. So there is a lot of the activity, but no more significant price drops. Such as situations could indicate that downtrend may be over and a reversal is near. Composites man WYCKOFF created the indeed of the components man as immaturity identity of the market. He proposed that investors and traders should study the stock market as if a single entity was controlling it. It always acts in his own best interest to ensure he can buy low and sell high. Think composite man as the evil entity, like the bad guy in a movie, sitting behind the sense control to markets by the pushing buttons. His goal is to move the markets to your disadvantage. The compromised man is continually sneaking to maximize his profit at your expense. The composed man's behavior is the opposite of retail traders, but according to WYCKOFF, the composite man uses a somewhat predictable strategy from which traders can learn from. Here are some main ideas of the composite man's. Composite man's plans and executed his detections well in advance. Composite man's is their fool you to buying positions that he was already accumulated. Composite man's will tempt you to sell at the worst position times. Composite man's leaves subtitle evidence of his strategy for those who at this stage here. Now, let's use the composite mind concept to illustrate a market cycle. First, accumulations. The process of the accumulations is the first stage of Wyckoff price cycle. The composed mind accumulates assets before the most investors. The accumulation is done gradually to avoid the price from changing significantly. Bulls are gaining power slowly, and as a result, they are poised to push price higher. Although the accumulation stage is related with the bulls gaining authority, the price actions on the chart is flat. In other words, the process of the accumulations is illustrated by the ranging price structures on the chart. Higher lows within the range is usually considered a signal that price actions is currently in the accumulation phase. Second, markups phase on trend. The markups is the second stage of the Wyckoff trading cycles. When composite demand is holding enough power and the selling force is depending, he starts pushing the market up. The emerging trend attracts more investors, causing demands of increase. There may be multiple phases of the accumulation during an uptrend. We may call them re-accumulation phase, where the bigger trend supports and consolidated from a while before continuing its upwards movement. As the market moves up, other traders are encouraged to buy. At this point, demand is higher than the supply. Third, distribution. The distribution process is the third stage of the Wyckoff price cycle. Here's a composite man starts distribution his holdings. He sells his profitable positions to those entries the market at the late stage. The distribution phase is marked by sideways movements that absorbs demand unit until it gets exhausted. The price actions on the chart at this stage is flat. One indication that the market is in a distribution stage will be the sustainable failure of the price to create higher lows on the chart. The price actions create lower highs, which is an indication that the market is currently experiencing a sell-off force. Markdown is downtrend. The markdown is the last stage of the Wyckoff price cycle. Soon after distribution phase, the market starts reverting to the downside. After the composite man is done selling a good amount of these shares, he starts pushing the market down. The supply becomes much greater than demand, and downtrend is established. When the bearish trend is finally over, a new accumulation phase being Wyckoff volume spread analysis. Volume is the great importance for the Wyckoff trades because it can provide valuable information into what is really going on behind the scenes. Wyckoff volume analysis provides confirmations of progress even during the Wyckoff price cycle. As I said earlier, high volume can lead to sustained price movements on the chart. Wyckoff volumes spread always also help you identify periods when the price is transitional between the different stages of the Wyckoff price cycles. When the price moves through a key levels during the Wyckoff price cycles, you should consider the move valid if the trading volumes are relatively high during the breakout. If the volumes are decreasing, then you're probably looking at the spring, which is false breakout, rather than the real breakout. This is an example of the accumulation stage. Noticed on the chart that the first two bottom are slightly increasing. This think that the market is likely the accumulation stage. Suddenly we see bearish breakdown through the lower level of the range. However, the volume is decreasing during the breakout through a level, which suggests that this could be a false breakout spring before the real breakout actually takes place. The price reverses after the breakdown, and at the same time the trading volume is increasing. This is the strong indications that the price cycle is likely entering the second stage, the markup. How to apply Wyckoff method in your trading trades can be Wyckoff price cycle to recognize upcoming price moves. For example, the end of the accumulation stage is behind of the markup, which could be traded for the long side. At the same time, the end of the distribution stage is beginning for the markdown, which could be a trade to the short side. Understanding the different stages within the price cycles will allow you to positions for the next month, most likely price tendency. Ideally, you should enter a trade when the price action is transitioning from the accumulations to markup and from distributions to markdown. First, you would need to confirm the current stage when the price is ranging. It would help to identify increasing bottoms for accumulations and decreasing tops for distributions. In addition to it would be useful to analyze the previous price moves for additional clues. Another way you can attempt to confirm the accumulations or distribution stage is by identifying a spring, which is the transitional price action behavior that often occurs between the cycle stages. Chart patterns can also be helpful in identifying accumulations and distribution process. On the chart, the potential price moves out of the pattern could help you identify the transitions to markup or markdown. The actual trade comes when the price actions breaks the range of the directions of the extended move. For example, you could buy when the price breaks the flat range through the upper level. Contrarily, you could sell when the price actions breaks the lower support level of distributions area, and you must keep an eye on volume to confirm that your decision is correct. If you are trading a markup, your stop losses should be located below the lowest point, the accumulation stage. If you are trading markdown, then your stop loss orders should be positions above the highest points during the distribution stage. Here the cycle begins when the distribution phase at this point the price actions breaks the upper level of the range. However, the trading volumes at that time are decreasing. Therefore, we can reason that the spring patterns on the chart may be forming. The price actions reverse afterwards and breaks the lower levels of the distribution channels on increasing volumes. This was the ideal momentum to enter the short position, placing a stop loss above the highest point of the distribution range. See that markdown begins right after the sell-off and the price is decreased aggressively. Then we see sideways movements, which hits that markdown phase is probably completed. If you haven't reached your profit target, you would close your target when the price actions begins to create increasing tops on chart. When price finished a markdown stage, it starts accumulation. During the accumulations, we see that the price drops and on decreased volumes and breaks the channel downwards. Here we see the breakout through the upper level of accumulation channel. So this is the strong buy signals which you could use to go long. The stop loss order goes below the lowest point of the accumulation phase. The price actions enters markup stages afterwards as the price rise, creating higher heights. After a strong increase, the price action starts to range, suggesting the markup stage is probably completed and the new distribution stage is on its way. This video was basically on the introductions of WYCKOFF trading. I tried to keep things as simple as possible. If you enjoyed this type of the content and you want more WYCKOFF strategies, leave us a like to show your support. In the future videos we will go deeper with some advantage WYCKOFF concept that can be applied to the day trading and swing trading. Until next time.